It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. Henry Ford. Understanding the evolution of money provides insight into how human societies have managed value, trade, and economic stability throughout history. Money has moved from being based on physical assets, like gold or silver, to the more abstract forms we use today, such as paper currency and digital tokens. This evolution reflects changing attitudes toward wealth, trust, and economic control, showing how innovation and adaptation have shaped the financial systems that underpin modern economies. Money's history is a window into economic development and social priorities. Ancient barter systems, which lacked standard measures of value, presented numerous challenges for trade. As societies grew, the need for a more efficient medium of exchange became clear. This prompted the introduction of commodity money, items with intrinsic value, such as livestock, grains, and eventually metals like gold and silver. These commodities provided a more reliable and divisible form of money, leading to the development of coinage, which was adopted by ancient civilizations to standardize trade and wealth storage. With the growth of wealth and trade, banking practices began to take shape, laying the foundation for modern financial systems. In medieval Europe, goldsmiths played a significant role in storing precious metals for individuals and issuing paper receipts as proof of deposit. Over time, these receipts evolved into a form of paper currency, used in transactions as a proxy for actual wealth held in storage. Banks emerged from these practices, and by the 17th century, institutions like the Bank of England were formalizing financial processes. One of the most significant developments during this period was the introduction of fractional reserve banking. Unlike full reserve banking, where banks were required to keep the total value of deposits in reserve, fractional reserve banking allowed them to lend out a portion of deposits while maintaining only a fraction in reserve. This system expanded the availability of credit and facilitated economic growth, but it also introduced risks. The ability of banks to create money through lending, by issuing loans, debt, beyond the physical reserves they held, played a major role in shaping monetary policy and the economy. It also raised questions about the stability of such a system, as it increased the risk of bank runs and inflation. The shift from commodity-backed currency to fiat money marked a pivotal moment in monetary history. While early paper currencies were often backed by gold or silver, governments and central banks increasingly moved toward issuing money that was not tied to a physical commodity. Fiat currency, by definition, derives its value from government regulation, law or military might, rather than an intrinsic or backed asset. This shift allowed for greater flexibility in monetary policy, particularly in times of economic distress, but it also carried risks. Historically, when governments printed excessive amounts of paper money, the result was often rapid inflation, eroding the purchasing power of the currency. A classic example is the hyperinflation in Weimar Germany in the 1920s, where overissuance of currency led to astronomical price increases and economic collapse. Similar concerns arise whenever central banks expand the money supply without corresponding economic growth, potentially destabilizing economies. The abandonment of the gold standard by most countries in the 20th century fully established fiat systems, wherein central banks could regulate the money supply without being constrained by a limited resource like gold. This move provided governments with more control over their economies, allowing for interventions to stabilize or stimulate growth. However, it also shifted monetary systems toward greater reliance on trust in the government and central banking institutions. The concept of sound money. Sound money refers to a monetary system that preserves its value over time and is resistant to manipulation. Historically, sound money has been associated with currencies backed by physical assets, such as gold or silver. The gold standard, for instance, was seen as a way to limit inflation and ensure that currencies retained their purchasing power. Under such a system, money is directly tied to a tangible asset. preventing the unchecked expansion of the money supply and encouraging responsible fiscal policy. Critics of fiat money often argue that it undermines the principles of sound money, as it allows governments to inflate the currency at will, leading to devaluation. The idea of sound money is central to economic theories that emphasize the importance of stable, long-term value preservation over short-term monetary policy interventions. While fiat currency offers flexibility in managing the economy, its critics highlight the risks of inflationary pressures and the long-term instability that can arise from excessive money printing. The debate over monetary policy often centers around two major schools of thought: Keynesian and Austrian economics. Keynesian economics, named after John Maynard Keynes, advocates for active government intervention in the economy, particularly during periods of recession. According to this view, governments should use monetary policy, such as adjusting interest rates or increasing the money supply, to stimulate demand and pull economies out of downturns. Keynesians argue that inflation can be a useful tool for driving economic growth and employment, as long as it is managed effectively. In contrast, Austrian economics, rooted in the work of economists like Ludwig von Mises and Friedrich Hayek, promotes the idea of limited government intervention and emphasizes the importance of sound money. Austrian economists argue that inflationary policies distort market signals, leading to unsustainable economic booms followed by severe busts. They favor hard currencies like gold-backed money, which limit the ability of governments to expand the money supply arbitrarily. According to Austrian theory, economies should be left to correct themselves naturally, without artificial stimulation, to prevent long-term economic instability. Both schools of thought have had a profound impact on monetary policy and the broader economy. While Keynesian ideas have dominated much of the 20th century policy landscape, the Austrian critique remains influential, particularly among advocates of fiscal conservatism. The rise of cryptocurrencies. The creation of Bitcoin in 2009, attributed to the pseudonymous figure Satoshi Nakamoto, marked a revolutionary moment in the history of money. In Nakamoto's white paper, Bitcoin, a peer-to-peer electronic cash system, he introduced blockchain technology as the foundation of a decentralized, secure, and transparent system for digital currencies. Bitcoin's appeal lies in its decentralized nature, operating without intermediaries like banks or governments. This makes it a potential hedge against the inflationary tendencies of fiat currencies, particularly since its supply is capped at 21 million coins, ensuring scarcity. Blockchain technology functions as a decentralized ledger where all transactions are recorded and verified by a network of participants called nodes. These nodes are computers that contribute to the network by confirming the validity of transactions. These nodes are operated by miners, who use computational power to solve complex puzzles that secure the blockchain and validate transactions. Once verified, these transactions are permanently recorded, making the system transparent and tamper-resistant. Pros and cons of cryptocurrencies. Cryptocurrencies provide a wide range of benefits that extend beyond mere decentralization. One key advantage is the accessibility they offer. Unlike traditional banking systems, which require infrastructure and formal identification, anyone with internet access can participate in the cryptocurrency ecosystem. This feature opens financial services to the unbanked and underbanked populations globally, offering a level of inclusion rarely seen in traditional financial systems. Another important benefit is transparency. Bitcoin, like many other cryptocurrencies, operates on a public blockchain where every transaction is recorded and can be audited. This transparency can reduce fraud, enhance accountability, and build trust in financial systems. Additionally, cryptocurrencies enable programmability. Through smart, self-executing contracts with the terms of the agreement directly written into code, users can automate a wide range of financial transactions, such as lending, borrowing, or insurance payouts, without needing third-party intermediaries. Blockchain technology uses cryptographic methods to secure transactions, making it highly resistant to hacking and fraud. Once a transaction is recorded on the blockchain, it is nearly impossible to alter, providing a high degree of security compared to traditional banking systems vulnerable to breaches. Forensic blockchain firms, such as Chainalysis, have developed advanced tools to track and analyze blockchain transactions. This capability undermines the notion that Bitcoin is primarily used for illegal purposes, as every transaction is publicly recorded and auditable, promoting accountability in the system. As a result, Bitcoin is increasingly being recognized as a legitimate and transparent financial tool rather than a haven for criminal activity. However, the volatility of cryptocurrencies remains a significant drawback, as prices can experience dramatic swings in short periods. This makes them less reliable for those seeking stability in investments. Regulatory uncertainty, while improving, still presents challenges. Different jurisdictions have taken varied approaches to the classification and taxation of cryptocurrencies, and this inconsistency can create confusion and hinder broader adoption. Despite these challenges, the continuous growth in institutional and retail interest suggests that cryptocurrencies are gradually solidifying their place in the global financial system. The rise of Bitcoin in 2009 was spurred by growing dissatisfaction with centralized financial systems, especially following the 2008 financial crisis. Trust in traditional institutions had diminished, and Bitcoin emerged as a decentralized alternative, enabling peer-to-peer transactions via blockchain technology. Its capped supply of 21 million coins also made it a scarce asset, increasing its appeal as a hedge against inflation. By May 2024, Bitcoin reached an all-time high of £59,000 and is currently trading at around £49,000 at the time of writing. Additionally, BlackRock's Bitcoin ETF, launched under the iShares Bitcoin Trust, IBIT, has amassed nearly £16 billion in assets. These moves indicate the growing confidence and demand from traditional financial institutions for cryptocurrency exposure. Cryptocurrencies offer significant advantages, one of the most important being the autonomy they provide users over their financial assets. Bitcoin transactions occur without intermediaries, enabling faster, more cost-effective transfers, particularly for cross-border payments. Its finite supply also safeguards against inflation, especially in economies where fiat currencies face devaluation due to government policies. However, some challenges remain. Bitcoin's volatility is a concern, as its price can fluctuate significantly, making it unpredictable in the short term. While regulatory uncertainty is gradually diminishing, with more governments acknowledging cryptocurrencies, the regulatory landscape still varies globally. Nonetheless, institutional adoption continues to bolster the legitimacy of cryptocurrencies, reinforcing their position as a viable asset class in the evolving financial ecosystem. The future of money is increasingly being shaped by the contrasting forces of decentralization and state control. Bitcoin's appeal lies in its inherent immutability, scarcity, and robust security, making it a reliable hedge against inflationary policies. The key narrative isn't about eliminating banks, but rather about empowering individuals with the freedom to use alternative means of transaction, such as Bitcoin and other cryptocurrencies, alongside traditional financial structures. Stablecoins play a crucial role in the evolving landscape of digital currencies, offering a bridge between traditional financial systems and decentralized technologies like Bitcoin. Pegged to stable assets like the US dollar or commodities, stablecoins provide the price stability that cryptocurrencies like Bitcoin often lack. This makes them particularly useful for everyday transactions and cross-border payments. By maintaining a stable value, stablecoins allow businesses and individuals to engage in the cryptocurrency ecosystem without being exposed to the volatility that typically accompanies digital assets. Their growing popularity reflects a demand for reliable, digital forms of currency that function alongside both decentralized and traditional financial systems. In contrast, the introduction of central bank digital currencies, CBDCs, government-backed digital money, raises distinct concerns. Many citizens are wary of the potential misuse of these programmable currencies, especially in countries where financial instruments have been used as tools for policy enforcement. The centralized framework of CBDCs fundamentally differs from Bitcoin's decentralized, censorship-resistant nature, making Bitcoin more attractive to those who prioritize financial sovereignty and independence. To give some perspective, Bitcoin's value has surged by an extraordinary 127 million% since its introduction in 2009. In contrast, traditional fiat currencies have not fared as well. During the same time period, the value of the British pound has decreased by around 24%, and the US dollar's purchasing power has similarly dropped by approximately 20%. Additionally, over the past 4 years, the US government has printed nearly 40% of all the US dollars ever created, primarily in response to the economic impacts of the COVID-19 pandemic, according to government sources. This monetary expansion is likely to continue, raising concerns about long-term currency devaluation. What remains uncertain is how governments and financial institutions will adapt to the ongoing rise of cryptocurrencies, particularly stablecoins, which many in the industry see as a practical alternative to traditional currencies. One certainty is that governments are unlikely to passively allow new financial systems to undermine their control over monetary policy and regulation. Historically, regulations framed under the guise of public safety have often been employed to rein in disruptive innovations. As the world transitions to these new forms of money, the hope is that the essential qualities that make cryptocurrency revolutionary, decentralization, security, and financial autonomy, are maintained, even as regulatory frameworks evolve. CoinLink, connecting your business to the future of money.